People do not buy cars anymore, they buy payment schedules. Imagine you have $10,000. By Tuesday, it is worth $6,000. And to make matters worse, you borrowed the $10,000 at 8% interest to buy something that is guaranteed to lose value every single day. Here is exactly how that happens. I want you to think of a modern car as a highly sophisticated, beautifully engineered block of ice. You buy it for $50,000. You finance this ice over 7 years. Every time you drive it, a little piece melts away. Every year it sits in your driveway, the market melts away another 15% of its value. But the bank still expects their fixed monthly payment for the original, completely frozen block. By decoupling the true cost of a vehicle from your monthly cash flow, the automotive industry has engineered a brilliant wealth extraction mechanism. We are actively financing rapidly depreciating assets with high-interest debt, and we are compounding our losses through negative equity, mandatory premium insurance, and the massive opportunity cost of misallocated capital. This specific financial habit is the single greatest destroyer of middle-class wealth operating today. My name is Tom, and I run the quantitative numbers so you do not have to. If mapping out the objective, mathematical reality of personal finance sounds like the best return on investment for your time today, hit that subscribe button. It costs you absolutely nothing, and it tells me to keep digging into the data. Now, let us look at the standard advice we have all heard 1,000 times. Always buy new or certified pre-owned for the warranty, because a $600 a month payment is supposedly cheaper than a $3,000 surprise repair bill. Or, my personal favourite, as long as you keep the monthly payment within your budget, you can afford the car. Society has completely normalised the permanent car payment because the broader economic system demands continuous consumption. We have been psychologically reconditioned over decades to equate reliable transportation with perpetual debt. But if we look at the data, this was not always the case. Post-World War II, cars were either cash purchases or financed over 12 to 24 short months. You owned the asset quickly. Today, you are basically renting a liability until it falls apart. As manufacturing costs outpaced median wage growth over the last 50 years, the automotive industry faced an existential crisis. Everyday consumers could no longer afford the principal balance of these machines. So, to maintain massive sales volumes, captive finance companies like Ford Motor Credit and Toyota Financial deliberately shifted the consumer focus from the total capitalized cost to the monthly payment. They did this by mathematically manipulating the term length. They stretched standard loans from 36 months to 48, then 60, then 72, and now we are routinely seeing 84-month auto loans as the industry standard. This tactic artificially suppresses the monthly cash flow impact, completely hiding the true macroeconomic cost from the buyer. Conventional wisdom fails us here because it fundamentally confuses cash flow survival with net worth accretion. Extending a loan makes a brand new car feel affordable on a monthly basis, but it makes that exact same transaction mathematically toxic to your personal balance sheet. We went from buying a machine outright to signing a subscription service contract, where the underlying product aggressively loses value the second you pull it off the lot. I call this the telescope illusion. Stretching a car loan from 36 to 84 months is exactly like looking through the wrong end of a telescope. The monthly payment looks incredibly small and entirely manageable. But the actual distance you must travel to reach financial independence becomes exponentially further away. That $500 monthly payment is just the wooden horse the dealership rolls into your household budget. It looks like a wonderful gift of affordability, but inside, hidden from view, are the soldiers that will slaughter your net worth. Things like compound interest, negative equity, gap insurance, and mandated comprehensive coverage. We are literally paying banks a premium to slowly drain our wealth, and we smile while we do it because the car has a fresh leather smell. It is a psychological masterpiece performed by the finance companies. But when you strip away the marketing and the shiny showrooms, the raw numbers tell a very different, much more alarming story about where your future wealth is actually going. If you think borrowing money for a car is just a necessary, harmless utility cost, wait until you see the actual math on an average auto loan today. It is absolutely brutal. Let us pull the current financial variables for a standard vehicle purchase. Right now, the average new car price sits right around $48,500. Due to sticky inflation and a higher for longer federal funds rate, the average auto loan interest rate is about 8.5% for new vehicles and over 11% for used models. Meanwhile, the standard term length, being aggressively pushed by dealers, is 72 to 84 months. And the depreciation curve is as unforgiving as ever. You are looking at a 20% loss in year 1 alone, followed by a 15% compounding loss in years 2 through 5. So, let us examine a buyer purchasing that $48,500 vehicle with $0 down at 8.5% interest over 84 months. The illusion here is powerful. The buyer drives off feeling victorious because the payment is just $768 a month. But let us run the total cost reality check. $768 a month multiplied by 84 months equals $64,512 paid out of pocket. Now we must factor in the depreciation drag. By year 7, assuming a standard depreciation curve, that car retains roughly 25% of its original value. Your $64,000 capital deployment is now sitting in your driveway worth exactly $12,125. The net wealth destruction here is staggering. When you subtract the retained asset value from the total capital you paid into the bank, you are left with a negative $52,387. You paid $52,000 for the simple privilege of daily transportation. This breaks the fundamental rule of wealth generation, which is to use leverage to acquire assets that yield a higher return than the cost of the debt. Auto loans break this rule violently. Borrowing at 8.5% to buy an asset that depreciates at 15% annually creates a 23.5% annual drag on your deployed capital. It is a mathematical black hole. Most people stop here, accept the loss, and sign the paperwork. Here is the massive opportunity cost step they miss. Let us introduce the opposing force. I call this the $15,000 protocol. Suppose an optimizer decides to buy a $15,000 reliable used vehicle instead. They finance it over 36 months at 11%, dealing with the higher used car rate. Their payment is $491 a month. Over 3 years, the total paid is $17,676. But here is where the cash flow arbitrage happens. The optimizer saves $277 a month compared to the new car buyer for the first 3 years. Then, for the remaining 4 years, they save the full $768 a month because their car is completely paid off. If they take that monthly difference and invest it into an S&P 500 index fund with a historical 9.5% nominal return, the results are shocking. By capturing that lost cash flow, you feed the compound interest engine instead of the captive finance company. After years 1 through 3, they have about $11,500 invested. By years 4 through 7, that initial $11,000 is compounding while they add the new $768 a month. At the end of the 84-month timeline, let us look at the math verdict. The conventional buyer has a heavily depreciated car worth $12,000 and $0 in the bank. The optimizer has a depreciated car worth $4,000 plus a liquid brokerage account holding $59,800. But the conventional path actually gets worse because of the double leverage penalty, also known as negative equity. Because depreciation vastly outpaces the principal paydown of an 84-month loan, you are instantly underwater. Early payments on long loans are overwhelmingly pure interest. In financial modeling, a loan is only considered healthy if the amortization line stays below the asset value line. Because of the math of an 84-month amortizing auto loan, those lines do not positively cross until month 62. For 5 solid years, the consumer holds a toxic, under-collateralized asset. If a life event forces a sale in year 3, they owe $33,000 on a car worth $25,000. They have to pay to sell their own car. Most people see that math, they know it makes objective sense, but they still walk into a dealership and lose $50,000 anyway. Here is the psychological trap they fall into, and why our brains are hardwired to make the wrong choice. The modern auto industry employs militarized behavioral economics. A dealership is not just a showroom. It is a highly controlled environment, perfectly optimized for temporal discounting. This is the well-documented human tendency to heavily weigh immediate rewards, like driving a pristine new car today, against future, abstract costs, like being completely broke in year 6. The first behavioral mechanic at play is the framing effect. Dealers are explicitly trained to never negotiate the actual price of the car. They only negotiate the payment. The very first question they ask is what you want your monthly payment to be. By doing this, they successfully reframe a massive balance sheet liability into a minor, manageable utility bill. You stop thinking about $50,000 of debt and start thinking about a slightly higher grocery bill. It is brilliant, and it works flawlessly to separate you from your capital. The second psychological mechanic is the sunk cost fallacy, which leads directly to the trade-in treadmill. When consumers realize they are deeply underwater on a car in year 3, they often feel financially trapped. The car suddenly needs a $1,000 repair, and the math feels totally overwhelming. This is exactly when the dealer swoops in, acting as the financial savior. They offer to pay off your trade and seamlessly roll that negative equity into a brand new loan. The consumer is so relieved to avoid the immediate repair bill that they do not realize what just happened. They are now essentially financing 2 separate cars at once, accepting a catastrophic 96-month term just to absorb the dead capital from the previous mistake. They are paying daily interest on a car that has already been crushed into scrap metal. It is a cycle of financial ruin that can last a decade. And then comes the Diderot effect, otherwise known as lifestyle creep. A shiny new car demands new, shiny behaviors. The buyer suddenly rationalizes paying for premium gas, ceramic coatings, subscription heated seats, and expensive accessories just to match the perceived status of the vehicle. But the most insidious hidden penalty of auto debt is the liquidity trap and mandated costs. People routinely ignore the secondary financial drain of carrying a car loan. When you finance a vehicle, the bank physically holds the title. Because they hold the title, they legally mandate full coverage, low deductible insurance to protect their collateral. In recent years, auto insurance premiums have surged astronomically. So the buyer is not just paying $768 for the loan, they are paying an artificially inflated $200 a month premium. A paid-off $15,000 car allows for optimized, liability-heavy insurance, freeing up even more monthly capital. Furthermore, auto debt acts as a heavy iron ball and chain on your career mobility. You simply cannot take a 20% pay cut to launch a high-upside startup or switch to a much more fulfilling career path if you have a mandatory $1,000 a month baseline just to keep your car insured and in the driveway. Debt systematically removes your options, and options are the true currency of wealth. You are letting a bank dictate your life choices for a depreciating piece of sheet metal. We have diagnosed the brutal math and the underlying psychology. But knowing the trap is only half the battle. We will get to the exact protocol for buying a car in a minute, but first we need to permanently fix the leak in your current cash flow. This is exactly why my team and I built Cash Class, the official Tom Talks Money web app. It is the direct bridge between learning the math on this channel and actually executing it in your own life. Most budgeting apps force you to hand over your sensitive bank login credentials, which I consider a massive security risk. Cash Class is built entirely with a strict privacy-first angle. There are no bank logins required. You simply download a standard CSV file of your statement from your bank, upload it to the web app, and our tools help you categorize and optimize your spending mathematically. It forces you to look at your real cash flow, not the fantasy version. Plus, it includes a completely free Budgeting 101 course to get your financial foundation rock solid. If you want to stop guessing and start optimizing, click the link at the very top of the description to start your 14-day free trial on the web right now. Now let us move to the strict optimizers protocol for buying a car. Do not rely on the vague, unhelpful advice to just buy a cheap used car. Optimizers use rigid mathematical algorithms to strip emotion entirely out of the purchase. Framework 1 is the 23-8 rule. This is your ultimate financial stress test. If you absolutely must finance a vehicle, you must pass this mathematical threshold. First, you must put 20% down. This instantly absorbs the year 1 depreciation hit, so you never cross into negative equity. Second, you must finance it on a strict 3-year or 36-month term. This forces rapid amortization. The principal paydown will continuously outpace the depreciation curve, keeping your balance sheet healthy. Third, your total monthly transportation cost cannot exceed 8% of your gross monthly income. That specifically includes the loan payment, auto insurance, and gas. The implementation of this rule is harsh but entirely necessary. If you cannot afford the car on a 36-month schedule, you simply cannot afford the car. You are merely using aggressive bank leverage to simulate a level of wealth you do not actually possess. Framework 2 is the net worth cap. You have to constantly remind yourself that vehicles are depreciating liabilities. To prevent them from acting as a systemic drag on your long-term portfolio growth, you have to strictly limit their footprint on your personal balance sheet. The rule here is that the total market value of all vehicles in your household must never exceed 10% of your liquid net worth. So, if you have $100,000 in liquid assets across cash and investments, the total value of your cars sitting in the garage should be absolutely no more than $10,000. Now, if you are under 30 years old and just starting to build your initial capital base, that 10% rule can be incredibly tough to meet. In that specific scenario, the alternative metric is to cap the total vehicle value at 15% of your gross annual income. This mathematical boundary forces you to respect the allocation of your capital and ensures your investment accounts always outperform your driveway. Framework 3 is the dealership disconnect algorithm. If you choose to purchase from a dealer, you must artificially separate the transaction into 3 isolated, mathematically distinct events. Never allow the finance manager to blend them together into a single monthly payment discussion. Event 1 is the asset valuation. You solely negotiate the out-the-door cash price of the car. Do not mention financing and absolutely do not mention a trade-in. Lock in the hard bottom dollar price first. Event 2 is capital sourcing. You must secure your financing before you ever step foot inside the building, ideally from a local credit union. Only use dealer financing if they offer a highly subsidized promotional rate, like 0.9%, that mathematically beats the risk-free rate of a standard treasury bill. That is the only time you accept positive arbitrage. Event 3 is asset disposal. Get written, verifiable purchase offers for your current car from places like CarMax or Carvana beforehand. Use that specific number as the hard mathematical floor for your trade-in negotiations. By ruthlessly isolating these three variables, you completely disarm the framing effect and retain control of your money. When you approach auto financing with this level of absolute mathematical clarity, the veil completely lifts. A high income is just a fire hose, and your net worth is a bucket. Buying a heavily financed, rapidly depreciating car is exactly like putting a massive, melting ice cube into your bucket. Not only does the ice cube take up valuable volume that should be reserved for productive capital, but it constantly leaks water out of the bucket through extreme depreciation. Borrowing money at 8% to buy melting ice is a mathematical paradox. To thrive in the modern economy, you have to consciously step off the permanent payment treadmill. You have to recognize that reliable transportation does not require you to sacrifice a guaranteed doubling cycle of your cash flow in the stock market. Every time you extend a loan term just to make a payment conveniently fit your budget, you are actively stealing from your future self to subsidize your current lifestyle. It is a slow, quiet drain on the middle class, dressed up as a modern convenience. The true luxury is not a heated steering wheel. The true luxury is total liquidity, zero negative equity, and the absolute freedom to direct your cash flow toward assets that actually grow. If you have made it this far and truly value this level of objective, hype-free financial analysis, I invite you to click the Join button below the video and become one of the optimizers. It is our channel membership where you get priority comment replies and custom sketch badges, and your membership directly supports the deep dive research we do here on the desk. Your support is exactly what keeps this channel running on hard data rather than cheap clickbait. Finally, I want to hear from you. We are gathering real-world data for a future video on predatory dealer tactics. Head down to the comments right now and leave your absolute worst dealership horror story. Or better yet, share a financial win where you used raw math to walk away from a terrible deal. Your peer review helps the entire community spot the traps long before they step in them. Until next time, keep your loan terms short, keep your cash flow highly liquid, and always remember that the numbers do not lie. I will see you all in the next breakdown.